So today we're talking about funded accounts versus live accounts. It's going to be a sort of raw, uncut type of video where I'm just going to be talking my mind, to be honest. And a couple of things I want to mention in this video that a lot of people haven't mentioned. As someone that has traded funded and has also traded live accounts, and I still do both of them to this day, I want to shed light on some things that people don't see. For example, let's get straight into this. And funded accounts, right? Everyone knows that this is a big buzzword now in the industry about funded accounts and all these prop firms. And the fact that they do, which is amazing, how they allow you to put in a smaller amount of money, $200-300, and get a large amount of capital, simulated capital, so 100k of capital, for example. But now the difference with the live account, obviously a lot of people don't have a lot of income to be putting in that account, which means that they only have sort of one route to make money kind of faster, and that's the funded account route. And a lot of people have asked me on my live streams which is better. Thing is, there's not really a specific answer which one's better, but I can tell you the drawdowns of both of them. And let's start off with the funded account drawbacks. So as trading funded accounts, I noticed that a lot of these companies, their business model is obviously, you know, if you've done a bit of research, their business model is they're banking on you failing your challenge. So then they make profit from that. And they're banking on more people to fail it than to pass it and get payouts. So that's how they make money, right? So it's kind of a bit of a dodgy business model, to be honest. You have the exception of firms such as FTMO and Funded Peaks, which is coming soon. These are ones that actually want you to do well because their way they are built is they are backed by like real investment firms and whatever. But let's not regard them because they are the top ones, right? If we look at all the other ones, they want you to lose. The conditions that they have, for example, Think Markets Broker that I have currently used, and I used to think it doesn't make a difference like what broker you use, but it does, because I've noticed that I'm getting slipped on entry 2 or 3 pips. I'm getting slipped on my TP 2 or 3 pips. That adds up now. Now it's about 5-6 pips I'm getting. And imagine you're only aiming for, say you're day trading, right? And you're aiming for 30 pips. You're losing 5 pips on that 30 pips. That's like you're losing like a sixth of your position just by entering it, which shouldn't happen, because now that's going to have an effect on your equity curve, going to affect your account over time. Your edge is going to get slowly nerfed by that. Not to mention, brokers like Think Markets have a high like commission rate, so it's like $7 per lot or something, which that will add up as well. So you're getting slipped, you're also losing on commission. And there's been countless times that I've gone stops to break even, because my strategy is on these day trades are going to be when it hits a certain point that I can see on the left, certain structure, resistance, I'll go stops to break even. That means my stop is at the entry price. I shouldn't be losing on that, right? But what happens is with these brokers is they're so bad in terms of the conditions, is I'm losing 0.3% on my position, 0.2%, 0.4% on these positions, even though I've gone stops to break even. Now that, you can imagine what that does over time. If you've got 5 break evens and you're getting slipped 0.3, you're losing 0.1, 0.5%. And that is a lot, because, you know, on your mental, all of that's a lot. You don't want to be anything to be against you, especially because you're trying to achieve a 15% in most cases profit target overall to get a live funded account. Another thing is obviously the drawdown. A lot of them have trailing drawdown, which no matter what trader you are, mathematically you're going to go through a period where you will hit that trailing drawdown. So stay away from any prop firms that have trailing drawdown. I'm literally just speaking my mind here, and there are some balance-based ones which are better, but then aiming for 15% over the year is a huge amount, because you have to think about it. To be a top trader, you're getting 15% of the whole year. So to get 15%, to just get an account which is simulated, and also the conditions might not be great, and also a lot of these firms, you don't know whether they're going to pay you out or not. There's so many times I've been waiting for a payout, they say 3 days, and it's taken a month, it's taken 2 weeks, it's taken 3 weeks, and back and forth, this and that. So that all goes against you, and it becomes sort of like a casino. I feel like these funders are becoming like a casino where the house will always have their own edge against your edge, which will, no matter how profitable you are, they will take a chunk off it. So you have to be extremely profitable to get profitable money. And if you're profitable, then you get a little bit less money. And if you're break even, you're actually going to lose money because of the way that they set this up. Now with the live account, for example, I have a live IC Markets account. I actually traded live accounts before I even got into funded. I used to flip them. I turned like a couple of thousands into like tens, 20,000, things like that. And that actually was something that I really enjoyed, the quality of the conditions in a regulated firm like IC Markets where you put your live account in. The only issue is obviously you can't realistically get 100k of capital like that, 200k, access to all these things. But the thing is, you get to keep 100% of the profits. The quality of the entries and the exits, the slippage is low, the spreads are low, everything about it is much better. If only you could get that sort of quality with conditions and a funded, that would be the perfect thing for me. But to be honest, I'm still going to trade fundeds. I am, but I don't see the point at all in going for lower fundeds anymore, because for me, I'm not taking my time to pass 15% on a funded just to have issues, and I'm fed up of all the issues with prop firms and things. A lot of you might know that I had 100k with MFF, which I just passed it, and I got taken off me. So that's another thing which was annoying. And left, right, centre, I'm here seeing on Twitter, this firm's getting taken down, that license getting taken off this firm. That I just can't be asked for all of that. So what I'm going to do is I'm going to fund again a fresh account on my personal money into IC Markets. I'm going to trade funders on the side. But another thing I would say is, if you are going for a smaller risk to reward, with their edge against you, your risk to reward is going to get nerfed. So I would say the minimum risk to reward, personally, I'm just thinking out loud, for most people that you're going to need for funded accounts is going to be something like a 1 to 2, because that way you can survive these drawdowns, you can get out of it, and even if they slip you on stops and TPs, you still roughly, you know, your risk to reward is big enough that the impact is slightly less. But yeah, to be honest, I've chatted a lot in this, but the conclusion is there's not really one's better than the other, because they both have positives. But what I would say, do both. Fund a small live account and go for a funded account as well. But don't do it in a way that the balance or the amount that you paid for the funded account doesn't mean anything to you, because if it blows, it shouldn't affect you emotionally, and the balance shouldn't affect you emotionally, and the profit target shouldn't affect you emotionally. So what I say is, open a live account. If you can copy trade from your live account to the funded, do that, because then that will just pass it in the background. Or if you have a different type of setup that's maybe a higher risk to reward, you take only the higher risk to reward setups on the fundeds, and then you do the smaller risk to reward setups on your live account where the conditions are better and it doesn't have as big of an impact with the slippage and things like that. So yeah, that's pretty much my thoughts on fundeds and live accounts. I just wanted to make a quick video on that. I hope you guys enjoyed and got a little bit of value from that, because from when everyone thinks that funders are going to make you rich, but yes, they can make you well, but 100k account's not going to be enough for you to quit your job. The average salary in the UK is probably about 25k. You're going to need 25% on that funded account. You're going to need more than that, because the profit split's like 80-20. You're going to need over 35% to get the average pay on a 100k account, which is kind of insane, you know, because even the top traders sometimes struggle to get that over the year. But yeah, that is my thoughts on the situation between funders and live accounts. I hope you guys enjoyed the video. Drop a like, subscribe. I'll try and drop more of these, like just random knowledge videos, I guess, based on my personal experience. So it's coming from like a true, you know, perspective on things.